Hey, Victor Kumar here, and welcome to Wednesday Wisdom. As you may have noticed, the finance landscape is changing rapidly. And the same thing happened back in 2017 to 2019, where APRA had stepped in and was starting to regulate how money was being lent to investors by putting constraints on the banks to how many of these investors they could lend to, so as a percentage of their lending book. Now, on top of that, there's several other things happening in the market that we need to take into account to then shape what we need to do immediately and what we need to do in the new year. So if you would recall that as of 1st of October, the federal home buyers assist scheme has kicked in. So this is where the federal government is guaranteeing the loans. So our homeowners are not required to pay lenders' mortgage insurance. In other words, they can go in with minimal deposits into their home. And now, what's also happening is that the home equity scheme, as different from the first home buyer scheme, the home equity scheme, where the government is going to take an equity stake on low income earner buyers to help them into the home ownership scheme or home ownership scenario. And what's happening here is that if it's an established property, the government will take up to 30% stake in the property. And if it's a brand new property, up to 40% stake in the property. So the homeowner needs to only show 2% savings. So if it's $1 million property, $20,000 to get into a home. Now we've got more buyers coming in. We've got more incentives. And of course, naturally, when government incentives come in, the prices go up. So how does that impact us as investors? Well, the finance landscape is changing, isn't it? And it is changing particularly for most lenders and therefore the investors. It'll change for the worse, not the better. And what do I mean by that? The APRA has just come out and said, okay, for all deposit taking institutes from 1st of February 2026, you are only allowed to have 20% of your lending book where the debt to income ratio to investors is above 6. Now, if you own multiple properties, or if you've got a big owner-occupier mortgage and then you're getting into investments, this is going to impact you. Right now, it may not, because most of the banks are sitting at about, in their books, they're sitting at about 10% or 15%, but they'll barrel up to the 20% very quickly. And so what you need to do, understanding that there will likely to be more changes out there to regulate the market from an APRA point of view, and at the same time the government is dropping in catalysts into the market to kickstart and further the participation of homeowners. For you as an investor, lending will change significantly. So what you need to do right now, on the assumption that there's more changes coming, that it'll be directed to investors from a financial point of view, you need to make your equity liquid as soon as you can. You need to reset your loans sooner rather than later, because come February, come March, you may not be able to do that because you may not qualify. You may not find enough lenders to approach. Compound that with the fact that we're barreling into Christmas and most banks will prioritize purchases over refinances and pre-approvals. You need to line up really quickly so that you're getting the base of all of the information to your broker right now, so that they can hit the ground running in January when they come back, to be able to get your loans restructured to extract your equity in preparation of opportunities that will come our way, given that the finance landscape is changing. That's your Wednesday Wisdom. I hope you found awesome value in it, and have an awesome week, and I'll see you again next week.